I am Dr. C. A. Shilpa Vasundhire, Professor with the Department of Management Sciences, Savitribai Phule, Pune University. Today, we are going to study the double entry accounting system. We are going to cover three parts: double entry accounting, then accounting and the rules of accounting, and then we are going to look at the conventions, concepts and assumptions in accounting. Let us go to the first part. What is double entry accounting? It was introduced by Luca Pacioli, a merchant in Italy, and he stressed upon the point that every transaction has two aspects. Both the aspects are recorded in the books of accounts. There are two accounts. For example, you are purchasing a machinery by paying cash. The machinery comes into the business and the cash goes out. Both are recorded. Therefore, there is a debit and a credit in every accounting system. Every debit, there must be a corresponding and equal credit, and every credit, there must be a corresponding and equal debit. Moving on, let us look at the advantages of the double entry accounting system. It helps to provide financial information. It helps in preparation of profit and loss account and balance sheet. Profitability and financial position of a business can be ascertained, and last but not the least, the arithmetical accuracy of the books of accounts can be checked and verified. Moving forward, let's have a look at certain definitions of accounting. The American Accounting Association defines accounting as the process of identifying, measuring and communicating economic information to permit informed judgments and decisions by the users of the information. According to the American Institute of Certified Public Accountants, it is defined as the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character, and interpreting the results thereof. So, these are the steps of accounting. It starts with the recording of information, classifying it, summarizing it, analyzing it, interpreting it and finally communicating it. Therefore, in short, recording, classifying, summarizing, analyzing, interpretation and communicating are the steps in accounting. As we go further, we are going to have a look at each of these steps in detail. Let us have a look at the history of accounting. In India, Kautilya's Arthashastra mentions accounting. Similarly, the Egyptian, Greeks, Romans and the Chinese had their own accounting systems in the past. As mentioned earlier, Luca Pacioli mentions the words debit and credit. Debit in Italian is debito and Latin is debita and debeo, owed to the proprietor. That is what it means. Credit, on the other hand, in Italian is credito and the Latin credo. Trust or belief is the meaning of the word credit. It is in the proprietor or owed by the proprietor. It is the meaning of the word credit. Moving ahead, let us have a look at the objectives of accounting. Systematic recording of transactions, ascertainment of results are the first two objectives of accounting. Ascertainment of financial position of the business and providing information to users for rational decision making are the other two objectives of accounting. Let us have a look at branches of accounting. Financial accounting, the profits and losses are determined in financial accounting. Cost accounting covers the cost accounting information and calculation of costs and fixation of selling prices of products and services. Management accounting, on the other hand, takes the information from financial accounting and cost accounting and is used for informed decision making. Social responsibility accounting and human resource accounting are the new branches of accounting which specifically talk about the social responsibility and the accounting of human resources. Going forward, let us have a look at the users of accounting information. Therefore, investors, employees, lenders, debtors and creditors, customers, government, public at large and the management of the organization are interested in the accounting information. Their decisions regarding investment, lending, taxation and taking further decisions are something which are used by the users of accounting information. There are three basic rules of accounting and there are three types of accounts. The types of accounts in the table you can see in the first column, which are personal account, real account and nominal account. There are three rules of accounting which are based on these three types of accounts. So, when it comes to real account, the rule is debit what comes in and credit what goes out. For personal account, debit the receiver and credit the giver, and for nominal accounts, debit the expenses and losses and credit again. No, yeah. Should I start? Yeah. Going further, let us have a look at types of accounts and rules of accounts. If you can see in the first column, there are the three types of accounts: real account, personal account and nominal account. Based on these type of accounts, there are three rules of accounting. These three rules of accounting are universal. So, when it is real accounts, it is debit what comes in and credit what goes out. When it comes to personal account, it is debit the receiver and credit the giver. For nominal accounts, the rule is debit the expenses and losses and credit the incomes and gains. Based on these three rules, the entire accounting system is based, and the accounting entries, ledger postings and the recording of transactions all over the world are done with the help of these three rules of accounting. When we will study journals and ledgers in the future, we will be visiting these three rules of accounting again. Going further, let us now have a look at the accounting concepts, conventions and principles. Let's see what accounting concepts are. Accounting concepts are those basic assumptions and conditions which form the basis upon which the accountancy is based. Accounting principles, on the other hand, are the body of doctrines commonly associated with the theory and procedures of accounting, serving as an explanation of current practices and as a guide for selection of conventions or procedures where alternative exist. Accounting conventions emerge out of accounting practices commonly known as accounting principles, adopted by various organizations over a period of time. These conventions are derived by usage and practice. Let us have a look at some concepts, conventions and principles in detail. The first one is the entity concept, which states that the business enterprise is a separate identity apart from its owner. The second one, money measurement concept. As per this concept, only those transactions which can be measured in terms of money are recorded. Next is the periodicity concept. It is also called the concept of definite accounting period. As per the going concern concept, an indefinite life of an entity, of a business entity that is assumed. Next, we have the accrual concept. Under the accrual concept, the effects of transactions and other events are recognized on mercantile basis, that is, when they occur and not as cash or cash equivalent is received or paid, and they are recorded in the accounting records and reported in the financial statements of the periods to which they relate. Next, you have the matching concept. In this concept, all the expenses are matched with the revenues of that period, and only those expenses which are matched with the revenue of that period should be taken into the consideration. Next, we have the going concern concept. Financial statements are normally prepared on the assumption that an enterprise is a going concern and will continue in operation for the foreseeable future. Next, we have the cost concept. By this concept, the value of an asset is to be determined on the basis of historical cost, in other words, acquisition cost. Then there is the realization concept. It closely follows the cost concept. Any change in the value of an asset is to be recorded only when the business realizes it. Let's see a few more concepts, conventions and principles. Dual aspect concept. This concept is a core of double entry bookkeeping system. Every transaction or event has two aspects. This is what this particular dual aspect concept states. Next, you have conservatism, which states that the accountant shall not anticipate any future income. However, they should provide for all possible losses. Then you have consistency, which says in order to achieve comparability of the financial statements of an enterprise through time, the accounting policies are followed consistently from one period to another. A change in the accounting policy is made only in certain exceptional circumstances. Lastly, you have materiality. All the items having significant economic effect on the business of an enterprise should be disclosed in the financial statements, and any insignificant item which only increase the work of the accountant but will not be relevant for the user's need should not be disclosed in the financial statements. There are further three fundamental accounting assumptions, which are going concern, consistency and accrual. Qualitative characteristics are the attributes that make the information provided in financial statements useful to the users. Understandability, relevance, reliability, comparability, materiality, faithful representation, substance over form, neutrality, prudence, full, fair and adequate disclosures, and completeness are the important qualitative characteristics of the financial statements. These are the references which are used for making this presentation, and the same books have been prescribed for study. With this, we come to the end of the session. Thank you very much for your patience listening, and if you have any queries or questions, you can post them on the email provided. Thank you very much.